In 2006, two families on the same street in Henderson, Nevada, bought houses within 3 months of each other. The Morrisons went first. Gary was 52, 26 years managing a distribution center for a national retailer. He and his wife Linda had saved $40,000 for a down payment. Their mortgage broker told them they qualified for a $410,000 home with only 5% down. Stated income loan, minimal documentation. The broker called it streamlined. Gary called it a miracle. They bought a 4-bedroom house for $405,000 in March 2006, put down $20,000, financed the rest at a 5.8% adjustable rate. Their neighbors, the Kowalskis, bought 3 months later. Ed was 57, 30 years as an electrical contractor. He had more money than Gary, could have bought a bigger house. Instead, Ed bought a smaller 3-bedroom for $280,000, put down $84,000, 20%, fixed rate at 6.2%. His monthly payment was $1,400 less than the Morrisons. Gary thought Ed was being ridiculous. "You're leaving money on the table," he told Ed over the fence one Saturday. "Real estate only goes up. Everyone knows that." Ed shrugged. "My father bought a house in Cleveland in 1928. Lost it in 1931, never owned property again until 1952. 24 years of renting because he bought at the top of a bubble nobody saw coming." Gary laughed. "That was the Depression. This is different." By March 2009, the Morrisons' house was appraised at $168,000. They owed $389,000 on the mortgage. They were $221,000 underwater. Gary's adjustable rate had climbed to 8.1%. Their monthly payment had increased by $740. The distribution center cut hours, then cut positions. Gary was laid off at 55. They lost the house in foreclosure in November 2009. Total financial damage? Approximately $190,000 in direct losses, plus the home equity they would have built over the next 15 years. Ed's house dropped to $194,000 at the bottom. He was not underwater. His fixed-rate payment never changed. He kept paying, he kept his house. By 2024, that house was worth $485,000. His $84,000 down payment had turned into $485,000 in equity. Same street, same neighborhood, same economy. Gary lost $190,000 and his home. Ed built $400,000 in wealth. Gary spent years afterward trying to understand what happened. What he eventually discovered was not just a story about one bad housing market. It was a pattern that had repeated with almost mechanical precision for over 100 years. The 1920s, the 1980s, the 2000s, the same 3 stages, the same leverage trap, the same generational destruction, every single time.
My name is Ban, and on this channel we study financial history. Not because it's interesting, though it is, but because it's the most profitable thing you can do with 40 minutes of your week. The people who recognized this housing pattern in 2005 and 2006 made billions. The people who missed it lost their homes, their retirement savings, and in some cases, their families. Today, I'm going to walk you through 100 years of housing data, show you the exact 3-stage cycle that has repeated 4 times in American history, introduce you to the people it destroyed and the one man who made $3.7 billion from it, and then show you exactly where we stand right now in 2026, because the data is telling a very specific story, and if you know how to read it, that story is not subtle. If you own a home right now, if you bought in the last 5 years at historically high prices, if you're between 45 and 65 and your house is the largest asset you own, stay with me. This is the most important 40-minute investment you will make this year. If this matters to you, hit subscribe right now. I keep breaking down the historical patterns that real estate agents and mortgage brokers will never discuss honestly, because their income depends on you not knowing. Hit that like button. It tells the algorithm to show this to more people who need to see 100 years of data before they make the biggest financial decision of their lives. Every housing bubble in American history has followed the same three-stage pattern. Once I show you this, you will never look at real estate the same way again. Stage 1. Easy credit plus displacement pressure. This stage lasts 3 to 5 years. It always starts the same way. Either the central bank creates cheap money, or deregulation opens the lending floodgates. Interest rates fall below the inflation rate, creating what economists call negative real rates. Borrowing becomes essentially free. Simultaneously, some demographic force creates real or perceived housing demand. In the 1920s, it was post-World War I urbanization. In the 2000s, it was millennials entering home buying age, plus government policy pushing homeownership. In 2020 and 2021, it was COVID forcing people out of cities, while the Fed cut rates to zero and printed $2.3 trillion. Then a new class of unqualified buyers enters the market. In the 1920s, Ponzi-era speculators buying empty Florida lots. In the 2000s, subprime borrowers approved for mortgages they could never repay. Today, first-time buyers putting 6% down while going into debt just to cover that down payment. 45% of first-time buyers are doing exactly that right now. They are borrowing money to borrow money. The price-to-income ratio disconnects from the 100-year average. This is the single most reliable bubble indicator in all of housing economics. The historical normal is 3.0 times median household income. In 1925, it reached 3.2 times. In 2006, it reached 4.6 times. Right now, in major metros, it's sitting between 5.5 and 6.0 times, nearly double the century-long norm. And then the media narrative shifts. The exact same phrases appear every cycle. Real estate never goes down. The housing shortage is permanent. You must buy now or be priced out forever. I could show you headlines from 1925, from 2005, and from 2021. If I removed the dates, you could not tell them apart. Stage 2, financial engineering peak. This stage lasts 2 to 3 years. Wall Street gets involved, not as investors, but as architects of complexity. They create new financial instruments to package risk and sell it to someone else. Lenders stop caring about borrower quality because loan origination is now completely divorced from loan risk. In the 1920s, real estate investment trusts and land trusts funneled speculative money into Florida. In the 1980s, S&Ls securitized mortgages and junk bonds funded commercial real estate. In the 2000s, mortgage-backed securities, CDOs, synthetic CDOs, and credit default swaps allowed banks to originate mortgages and immediately offload all risk. The result is always the same. Stated income loans become normal. No documentation mortgages become standard. Subprime lending grew from 8% of all originations in 2003 to 20% by 2006. Alt-A mortgages, minimal documentation, accounted for another 12% on top of that. Nearly a third of all mortgages written in America required little to no proof the borrower could pay. Stage 3, trigger event plus cascading collapse. This is where it breaks, and it always breaks. In 1926, a hurricane revealed that 75% of the properties people had leveraged their savings to buy had no actual structures on them. Empty lots, paper deeds to dirt. Credit froze overnight. In 1929, the stock market crash forced margin calls that dried up real estate credit across the entire country. In the 1980s, interest rates spiked to over 10%. 1,043 savings and loan institutions failed. Cost taxpayers $123.8 billion, which is $340 billion in today's money. In 2008, on September 15th, Lehman Brothers collapsed, not gradually, overnight. The credit market seized completely. The result of every stage 3 is identical. Credit seizes. Homeowners who bought with leverage discover nobody will refinance them. Prices fall until they reach a level that cash buyers, not leveraged buyers, are willing to pay. Historically, that means a 25 to 40% decline from peak. The reason housing collapses are so devastating, far more devastating than stock market crashes, comes down to one word: leverage. The median homeowner who purchased between 2004 and 2006 put down 3 to 5%. They controlled $200,000 or more in assets with $5,000 to $10,000 of their own money. That is 20 to 1, sometimes 40 to 1 leverage. Now think about what happens when prices fall 20 to 30%. On a $200,000 home purchased with $10,000 down, a 20% price decline doesn't mean you lost 20% of your investment. It means you've lost 100% of your equity, and you still owe more than the house is worth. You're underwater. You can't sell without writing a check. You can't refinance because no bank will lend against negative equity. You're trapped.
Between June 2006 and March 2012, U.S. home values fell $3.3 trillion in aggregate. Not theoretical loss, destruction of actual asset value. Individual homeowners in Las Vegas, Phoenix, Miami, and inland California lost an average of $112,000 per home. In 2010, the peak foreclosure year, 3.8 million foreclosure filings hit the system, 9.6% of all mortgaged properties in America. By 2014, 8.7 million homes had been foreclosed since the bubble burst. Toll Brothers went from $95 a share in October 2007 to $8.30 in March 2009. 50,000 employees, $3.1 billion in write-downs. It took until 2013 for the stock to recover. Housing bubbles don't destroy everyone equally. They systematically devastate people aged 55 and older every single time. And the data on this is brutal. During the Great Depression, Americans aged 65 and over who owned homes saw their net worth decline 68% between 1929 and 1933. 68%. And studies show that 40% of Depression-era homeowners never returned to 1929 wealth levels even by 1950, 20 years later. They never recovered. For many, the home was their primary wealth transfer mechanism. When it was destroyed, the wealth transfer to the next generation was eliminated entirely. The same pattern repeated in 2008. Americans aged 55 to 74 experienced the highest percentage increase in foreclosure rates. Adults over 60 saw foreclosure rates triple between 2007 and 2011. A 35-year-old who lost their home in 2009 had 30 years of earning power ahead. A 62-year-old had 3. This is exactly what the data shows forming again right now. The 45 to 65 cohort in 2026 is caught in what I call the rate lock dilemma. Millions of homeowners in this age group purchased or refinanced between 2019 and 2022 at mortgage rates of 3 to 4%. They now sit in homes they functionally cannot sell because any buyer today would face rates of 6.5 to 7.25%, which crushes both demand and price. They're not underwater yet, but they're frozen, and frozen is the precondition to underwater when the trigger arrives. Let me tell you about 2 men. One was among the richest people in America. The other made himself the richest by studying what destroyed the first. Billy Durant co-founded General Motors in 1908. By 1920, his fortune was estimated at over $100 million, the equivalent of $1.4 billion today. During the 1920s Florida land boom, Durant invested heavily in Miami real estate, purchasing land at $500 to $1,000 an acre in 1924, expecting to flip it for $5,000 to $10,000 an acre. The 1926 hurricane hit. Credit froze. Durant lost an estimated $5 to $10 million in real estate alone, $70 to $140 million in today's dollars. Then the 1929 stock crash hit. He was forced to liquidate at further losses. Within 7 years, Billy Durant went from the equivalent of a billionaire to bankrupt. He died in relative poverty in 1947, the founder of General Motors, destroyed by housing leverage. Charles Ponzi, the man whose name became synonymous with financial fraud, his real estate losses actually destroyed him more thoroughly than his famous postal coupon scheme. In 1920, he acquired $2.5 million in Boston real estate, about $44 million today, entirely with borrowed money. By 21, every property was underwater and seized. He died in poverty in 1949. Now compare them to John Paulson. In 2005 and 2006, when housing prices seemed unstoppable, Paulson studied the historical pattern. He saw stage 1, he saw stage 2, he saw the leverage multiplication, the wage disconnect, the credit expansion to unqualified buyers, and the politician denial. He recognized that the 1920s and the 1980s were repeating in real time, so he bet against it. He created credit default swaps on mortgage-backed securities, essentially insurance policies that paid off when those securities failed. In 2007 alone, John Paulson made $3.7 billion. That $3.7 billion wasn't luck. It was pattern recognition applied to 100 years of data, the same data I just showed you. And then there's Roland Harriman, a senior partner at Lehman Brothers who witnessed the S&L crisis firsthand in the 1980s. His firm actually profited from it, buying failed S&L assets at 30 to 50 cents on the dollar. But Harriman became cautious. In interviews in the 1990s, he warned that housing leverage would return and cause catastrophic problems. He was ignored, and his own firm, Lehman Brothers, was destroyed by the exact same mortgage patterns he had cautioned against. The man who saw the pattern couldn't even save his own institution from it. Median home price, $425,000 to $450,000. Median household income, $75,000. Price-to-income ratio, 5.5 to 6 times. The 100-year average is 3 times. Mortgage rates, 6.5 to 7.25% versus 3.2% in 2021. Average first-time buyer down payment, 6%, and 45% of those buyers are going into debt just to cover that 6%. Home prices spiked 40% in just 2 years between 2020 and 2022, the fastest price appreciation in American history, faster than the 1920s, faster than 2006. Home affordability, lowest level in 40 years. Sales volumes, down 26% year over year. Commercial real estate defaults, accelerating. Regional banking stress, emerging.
Let me be direct with you because that's what this channel does. I cannot tell you what the trigger will be for this cycle. Nobody predicted the 1926 hurricane. Nobody predicted Lehman Brothers on September 14, 2008. The trigger is, by definition, unpredictable. What I can tell you is that every single leading indicator that preceded the previous 4 collapses is present right now. The wage disconnect, the leverage multiplication, the credit expansion to unqualified buyers, the politician denial, Treasury saying the fundamentals are sound, the media narrative of permanent shortage. In every prior cycle, the people who said this time is different were wrong, every single time, for 100 years. History doesn't just warn you, it instructs you. Here's what 100 years of data tells us about positioning. First, understand your leverage exposure. If you own a home with less than 20% equity, you are leveraged. If you bought between 2020 and 2022 at peak prices with a small down payment, you're carrying the same leverage profile as buyers in 2005. That doesn't mean panic sell. It means know your number. If prices dropped 25% tomorrow, would you be underwater? Answer that question now. Second, do not buy expecting appreciation. The phrase real estate never goes down has been proven catastrophically wrong in 1926, 1933, 1989, and 2008. It will be proven wrong again. Buy a home because you need a home you can afford, not because you expect the price to make you wealthy. Third, if you're 45 to 65, this matters more for you than anyone else. The historical data is specific. This cohort suffers disproportionately in every correction because they have the least time to recover. Stress test your finances against the 20 to 30% home value decline. Can you still retire? Can you still meet obligations?
If the answer is no, that information is more valuable now than it will be after the correction. Fourth, cash is positioning, not panic. In every housing collapse, prices fall until cash buyers set the floor. The people who built cash reserves before 2008 bought foreclosed properties at 28% below market value. Lehman's competitors bought failed S&L assets at 30 to 50 cents on the dollar during the 1980s. Having liquidity when credit freezes is the single most powerful position in a housing correction. Build positions in assets that don't correlate with housing: gold, farmland REITs, consumer staples, long-term treasuries, assets that rose or held value when housing collapsed. Fifth, watch the price-to-income ratio, not the headlines. Politicians will deny the bubble. Media will alternate between permanent shortage and crash imminent depending on what generates clicks. Neither is useful. The price-to-income ratio has predicted every bubble and every correction for a century. At 3 times income, fairly valued. At 5.5 to 6 times income, as it is right now, the math is unsustainable. Math doesn't care about narratives. Sixth, think in cycles, not years. The 1930s housing recovery took 15 years. The S&L recovery took a decade. The 2008 recovery took 6 to 7 years before prices returned to pre-crisis levels. If a correction begins in the next 1 to 3 years, the recovery window extends to the early to mid-2030s. Position your life decisions accordingly. Let me bring this full circle. In 1925, Billy Durant, one of the richest men in America, looked at Miami real estate and saw permanent value. He saw a booming market, rising prices, and a narrative that said it could never end. Within 7 years, he was bankrupt. In 2005, John Paulson looked at the exact same type of market and saw something entirely different. He saw a pattern, a 100-year-old pattern of easy credit, financial engineering, leverage multiplication, and inevitable collapse. He bet on the pattern. He made $3.7 billion. The difference between Durant and Paulson wasn't intelligence. Durant literally built General Motors. The difference was that Paulson studied the history. He knew what the 1920s looked like. He knew what the 1980s looked like, and he recognized the same architecture assembling around him in real time. Right now, the price-to-income ratio is higher than it was in 2006. First-time buyer leverage is more aggressive than 2005. The fastest price appreciation in American history happened between 2020 and 2022. Commercial real estate stress is building. Regional banks are under pressure. I'm not predicting a crash. Historians don't predict. We identify patterns and measure probabilities. And what I can tell you with certainty is that the 3-stage cycle has completed its full rotation 4 times in 100 years. The conditions for stage 3 are present. Whether the trigger arrives in 2026 or 2028, no one can say, but the conditions are measurable and they match. The question, the same question that separated Durant from Paulson, that separated the 40% of Depression-era homeowners who never recovered from the ones who bought foreclosures at the bottom, is whether you'll recognize the pattern before the trigger or after. You now have 100 years of data. You know the 3 stages. You know the leverage trap. You know which generation gets hurt the worst. You know how the recovery timeline works. Gary Morrison learned this lesson in 2009 at 55 after losing his house and $190,000. He was still renting at 63, rebuilding a credit score destroyed 7 years earlier. Ed Kowalski learned it from his father, who learned it the hard way in Cleveland in 1928. Ed retired at 63 with $485,000 in home equity and a diversified portfolio that generated income regardless of what the housing market did. Same street, same economy, same crisis. The only difference was that one family understood the 100-year pattern. The other had been told this time is different. If this changed how you think about your home and your financial position, do me a favor and share this with someone who needs to hear it. A friend who bought in 2021 with 3% down, a sibling who believes their home equity is guaranteed, a spouse who needs to see 100 years of data before the next financial decision your family makes together. Hit subscribe, because next week I'm showing you 3 regional housing markets with 30-day mortgage delinquencies are already spiking. I'm Ban. This is financial history that pays. Stay sharp out there.